Let's just give it a couple minutes. I see some friendly faces in the crowd. That's pretty exciting. We've muted everybody, but at the end, we're happy to answer any questions that you might have and have a discussion. Aaron and I, you will find, are very, very open people and happy to expand on anything that is on your minds. But for now, muting might make it a whole lot more efficient. All right, let's see here what we got. If you have questions along the way or something that you want us to talk about, please feel free to use the chat feature as well. And at the end, unmute and you can ask whatever questions you would like. How about that? All right, Aaron, I think I've let everybody in that's going to join us live. And I will let you introduce yourself. Let me make sure I have these slides shared. Can you see my slides, Aaron?
Slides look good, yes.
All right. Okay, so why don't you kick us off and introduce yourself, my friend, and we will get things started.
Cool. Hey everyone, my name's Aaron Stocks. I'm the CEO of PFS Global. It's nothing cool, it's just a title I gave myself, but basically provide accounting service to independent agents. My background is accounting. That's all I know and done my whole life, so not very good at anything else, but hopefully I'm good at this.
I love it. I love it. And for those of you that don't know me, my name is Carey Wallace. I am the founder and owner of AgencyFocus, which is a company that is primarily works only with independent insurance agents. We help agents understand their value. We act as a fractional CFO. We do valuation and perpetuation planning for independent insurance agents. And basically, our overall goal is to help agents understand their financial position, maximize the value of their agency, and help simplify and make financial decisions much more efficient for independent insurance agents. So the purpose of this webinar today is really meant to talk about how accounting and finance or CFO services work together, and talk about the importance of having solid financials in order to position you to best understand the health of your agency. So Aaron, I think we should probably talk a little bit about why we're together doing this webinar together, like how our partnership formed.
Yeah, absolutely. I think that, as me and Carey were bopping along in the world and, servicing our clients, we'd constantly get requests for each other's needs, right? Hey, Aaron, these are great financials. I appreciate it. Now what? Right? Or, hey, I'm looking to sell my agency. I need a valuation. Or, how do I grow my agency using the numbers you gave me? Right? And so we'd get that question all the time. On the reverse, Carey's like, hey, I can help you grow your business, but these numbers aren't accurate. Or we need to, come up with a different chart of accounts and get it in your books. So it's just a natural fit for me and Carey to partner together on, PFS creates an accurate set of financials that can be used, and Carey will use that to provide the CFO advisory services that she provides so well. So that's how, we met, which was just more natural, and I think it's the best kind of a relationship to have.
Yeah, and I think the important part is having someone who understands the nuances of an independent insurance agent rather than someone local that might service a lot of different clients with a lot of different business structures and a lot of different needs. I was looking for a place where I could send my clients that would have someone who understands who they are and isn't learning on them. And I think vice versa. Like I could do fractional CFO work for lots of different companies, but I've chosen this industry so I can be an expert and really understand the things that are the nuances and those things that increase the value, the things that actually impact the health of the agency, and really go super, super deep with the clients that I work with rather than trying to be an inch deep with a whole bunch of different clients. So I think it was a really nice way to marry together. All right, so let's dive in and talk about exactly what things we should be paying attention to inside an agency. So I'm going to let you take this.
Cool. So step one, make sure your financials are accurate. It's a pretty easy statement to say, but rather hard to accomplish. But really a good baseline here is if your financials aren't accurate, everything that they rely on that relies on those financials aren't accurate. That could be your tax returns. That could be the financials themselves that you're using to prepare for an exit, for evaluation, just for management use, right? If your financials aren't accurate, everything that relies on those financials will be inaccurate. And we run into this mostly on our end with tax preparation. If your books aren't right, the financials aren't right, then the taxes are naturally wrong. And so we deal with that quite often where we'll have an agency come to us and we're doing the tax returns and the books just aren't accurate. And so then we know that the tax returns are going to need some corrections. So that's why we need to make sure our financials are accurate. Some common mistakes we run into, and you guys can go check your own financials for these mistakes, are if you see any type of premium on the income statement instead of flowing through the balance sheet, that means the trust accounting is just done incorrectly. If you have two different types of general ledgers, so if you have one in QuickBooks and one in AMS 360, or two different QuickBooks files because you have your trust account separately, that's a very common mistake that we run into, which means that the financials would be inaccurate. And there's plenty more that we can go through, but just a little common mistakes there. I think to
Yeah.
go ahead, Carey.
The only thing I would add to that is, it's not just to, for tax preparation. Sometimes having accurate financials can change your ability to acquire a loan if you're looking to acquire an agency. And you might be moving along for a long time and have reported your financials the way that they are. And then an outside group is looking at them in order to administer a loan or whatever. And then you find out that I've been looking at things that are wrong. We had an agency that was looking to sell, sent us their financials. They had premium on their financial statement. They used cost of goods sold as what they were paying their carriers. But sadly, the way they put it in QuickBooks was actually double counting it. So this guy had in his mind that he wanted 2.5 times revenue, but he all along his revenue number was actually wrong for the thing that he was thinking. So he was feeling like, I know what the value of my agency is and I have in my mind what the price should be, but because his statements were wrong, his whole impression of what he thought he could get out of his agency was inaccurate. And we couldn't use the buyer's financial and his financials in order to get to a loan. So it's having these things day in and day out be accurate can set up the right expectations for what you're having inside your agency. And if you don't have any external review of them, you might have it tell you the wrong story for years. So it's crazy important to make sure that these are accurate and things that you can base your decisions on.
Absolutely. You can also have competing forces too, Carey, right? Like the bookkeeper might have a strategy for your books. The tax person might have a different strategy. Carey might have a strategy, and the lender might have a strategy, right? And so to bring all of those strategies together is difficult, but it's something that must be done because if you are, you have four different competing forces and you're all trying to implement different things, it really can create a mess in the books. Um, cool. Over to the next slide, which is key areas to get right. So, if you do anything wrong or right in the books, these three areas will really help you keep your books in line. So number one is the trust accounting. So if you have a lot of agency bill commissions, having your trust accounting done right is crucial. That's breaking up the fiduciary and non-fiduciary funds properly on the receipts in the AMS, and then bringing those over into your general ledger. That's very important. That's probably one of the biggest mistakes people have is their trust accounting, just so everyone's aware. So we run into this all the time because it really does involve going into the AMS to get the data out, right? And so if you have, maybe you're doing the accounting yourself, or it's some firm down the street that doesn't have independent insurance agency experience, you'll run into the trust accounting issues a lot because they have to go into the AMS to get them, and they might not do that, or if they do that, they don't, know what they're looking at, and that is a big issue. So getting your trust accounting done right is important on some frequency. At least once a month would be ideal, but more frequent if you have more agency bill volume. Reconciling your direct bill commissions will be next. So if you don't reconcile your direct bill commissions, not everyone has to. Like if you don't have producers, you don't necessarily have to reconcile them, but you probably are missing money from the carrier, and a direct bill commission reconciliation can show you what is missing, or at least show if there's mistakes that are coming up. It also will be able to provide more advanced reporting in your AMS typically if you reconcile your commissions. So it depends on your AMS. Some kind of require you to reconcile your direct bill commissions. Like if you're an Epic or AMS 360, you really have to, or you're not going to have very accurate financials. If you're in an AMS like Hawksoft, you can get away with not reconciling those if you don't have producers, but it's always suggested. The last
So
part,
here,
yeah, go ahead, Carey.
So here's what I'll say about direct bill commissions. So if you aren't reconciling your commissions and you're thinking about selling your agency, I will tell you that there will be a process by which the buyer wants to see what is on your financial statements for revenue and then pull out your carrier reports and double check to make sure that those are accurate because they want to know what they're buying. And if you are an agency that is doing your direct bill commission reconciliation and you know that the book of business report that you provide and your financial statements are going to align, I liken it to a house that's for sale that doesn't have any improvements or any unknowns. As soon as there's an unknown or a discrepancy, that buyer doesn't know exactly what else might be wrong, and therefore there could be a discount applied or a retention mechanism to that purchase. So the more accurate your financials are, the more confident they are that they know what they're doing. And part of that is this reconciliation process.
Yeah, it definitely shows a level of sophistication too. And, one of the points Carey will probably get to later is, you know, someone wants to buy your agency that can replicate what you're doing, right? If you were to
Right.
leave or retire, they want to buy something that they can, duplicate that adds more value. And so if you're not reconciling your direct bill commissions because you don't have producers, or even if you do, but you just kind of piece together some commissions, it does, in essence, bring down the value or the trust and the sophistication of your agency on that. It's harder to duplicate that process now because you're not reconciling your commissions.
Yep, definitely.
Cool. The last and probably like the biggest umbrella is this process of month-end closing, right? So, you can have a small agency and you can use, Hawksoft and QuickBooks Online, both great products. You can use bank feed downloads and QuickBooks Online and categorize them, right? But if you're not doing a month-end closing whereby you're making at least some journal entries like for payroll or for corrections or reviewing the classifications, then your books will slowly get worse, right? And we'll get more into financial statements later, but keep in mind that your books aren't just like a period of time, like this month I messed up my books, no big deal, I'll move to next month. They accumulate over time, right? And so the more misclassifications you have without having a month-end closing, the slowly your books will become more and more inaccurate over the years. And so we'll run into people where they haven't done a proper month-end close for 5 years. And the first month, it's not off a lot, but 5 years, down the road, they do really get off by quite a bit just because there's no month-end closing process that's being done.
Yeah, and I'll say there's a lot of people that come to us and say, hey, listen, this has gotten beyond what I can do. And there's a cleanup process that has to happen because if you want your financials to lead you to decisions, it's got to be accurate. And my team finds it when we do evaluation for someone or we're doing a benchmarking report for someone or they have a specific thing that they want us to do. And we find discrepancies in their financials that don't make sense, then we will refer them to Aaron's team to say, you've got to go do some cleanup. Because if you truly want to make sound decisions, you have to have the data telling you something. So I asked, when we were thinking about how do we talk about these two things and how they work together, this is how I envision it because I'm a visual person. I need to know how things work on. And from my perspective, accounting is the foundation upon which you can see what's happened in your agency, what's happened in your business. So you have a monthly financial statement that would include a profit and loss statement, your balance sheet, and for some, a cash flow statement. Those are the things that have already happened. And you can say with clarity that you know exactly where you stand that day. We already talked about that agency bill and direct bill reconciliation, but again, that's already what's happened. We're going to reconcile and say, where do we stand today? So we're going to know what's in our balance, what's on our bank account, what's all those things. We're going to have a bank reconciliation, the month-end close statement, and then we can prepare for tax compliance and reporting. All of that is historical. I view like the space between accounting and finance is today, where finance looks at, now that we have this foundation, how can we look forward? How can we tell how we're doing based on the plan that we set out or the budget that we set for our agency? And how do we think about if we want to position ourselves in the next 3 to 5 years to grow to a certain amount? What things do we need to have happen in order to make that occur? If I don't have sound financials to start with, I can't build a forecast with any confidence that I know what I can plan for the future. Same thing, I can't determine an agency's worth, or my team certainly can't determine a sound agency's worth if the financial statements aren't sound. So I view accounting as the bricks upon which we build in order to help someone figure out if they can acquire, which ways they should make investments in the agency, think about their compensation structures today and what they should be in the future, their hiring strategies, transitioning ownerships. Like there's a lot of different decisions that you want to make as you're planning for the future of your agency. And without this core foundation, it makes it really difficult to make that future thought process, especially if you've had a compounding problem with your financial statements that are wrong. For instance, the agency I was telling you about that had premium intermixed on his profit and loss statement and thought his revenue overall was wrong. His tax returns were wrong, but not only that, his thought process about what his agency was worth was wrong. And how devastating is that to learn because you truly didn't know what the numbers meant? I have a lot of people that tell me, I'm not a financial person. I'm a relationship person. I can build trust and relationships and I can give advice to my clients. But when I look at numbers, it actually, causes me stress because I don't know what to think about the numbers that are on the page. I view our team as putting sense to what those numbers mean and giving context to what those numbers mean. And then the way in order for you to start making decisions about how you want to run your business and connecting those decisions to the financial performance of the agency. And without Aaron's team, it's based on a crumbling rocks rather than building blocks. So
And I think on that, Carey, just logistically to simplify it is, when you have your accounting team preparing these financials, right? And it could be direct bill, commission reconciliation, trust accounting, etc., month-end closing. Once those financials are produced, very simply, that's when those get sent over to Carey's team, right? And then Carey's team takes over there. So think about a normal monthly cycle. January has happened. Now we're in February. Sometime in February, the January books will be closed, the financials will be completed, and then they'll be sent over to Carey's team. And that's kind of how that split works. And Carey's team would then take on that other side of future, projections or things that matter in the future versus just being historical with the accounting.
yeah, our team would answer things like, well, how do we do compared to budget? How are we doing in a cash flow statement? Are we positioned if we have an acquisition opportunity come up? What would that look like? Are we on track for our overall forecast? Can I hire based on the performance I'm at today? If I'm beating my budget, do I have the capacity to add and expand my team? Should I pull back on my team because we are not performing the way that we thought that we should? So are there expenses that I plan for in the future later in the year that I should consider pulling back on, and at what degree? So having a budget and a forecast for the year allows you to make much more informed and quicker decisions rather than waiting for year end to say, oh, wait, I guess next year I can hire because I'm not really sure where I stand this year. Or I'm not sure mid-year where I'm really going to end up because I don't have anything to compare it to. It really allows people to make faster decisions when they can have something to compare it to. So the statement that we spend a lot of time on is the profit and loss statement, which is the one you're looking at. This shows revenue at the top. It shows revenue by commission and fee income, agency bill income, and then other revenue that would fluctuate a certain amount, which is contingency or miscellaneous income as well, on there to give your overall net revenue. And then you can see the core classifications of expenses. And the reason I shared this particular financial statement is this is organized based on best practices, categories of expenses in our industry. So if you want to know how you're doing compared to other agencies of your size, other agencies in your region, other agencies in general, having your financial statements organized in the same way allows you to do apples to apples. That's one of the ways that you can say, you can gauge, how am I doing? If your statement has just one line item that says operating expenses and it doesn't break it out by your rent, your equipment, your IT, you can't start asking yourself, how am I allocating my resources? How do other agencies do this that are of like size? Am I over allocating in one area that's impeding my ability to run a profitable business, but also invest in the things that might drive growth? So we've organized it as revenue, expenses, and your profitability, and we're showing the percentage of revenue that you're allocating to each of these categories. So for instance, this agency, which is a completely fictitious agency, by the way, is allocating 44.2% of their total revenue to payroll. Well, they would be under the benchmark by comparison of other agencies this size, but you can also see their overall profitability is at a 31.4, which is also beating the benchmark for agencies that size. Our team can help you know how you compare to those benchmarks based on the size of the agency. And it makes these page of numbers start to make sense. Whereas many people are look at these numbers and like, great, I just want to know what's in my bank account, which would be the balance sheet anyway. Like it really gives context, if you will.
I love when we get an email from a Carey client. They'll be like, "Can you give me the last 2 years of our, IT expense or whatever it might be?" And I'll be like, "Oh, I know they just had a meeting and something jumped off the page." And that's the power you get with reviewing these. I can send financials all day to a client, but reviewing them in detail with a professional like Carey's team is really what, you know, has results on moving the needle, right? And so again, I'll get an email, "Hey, can I get my payroll breakdowns for the last 3 months or whatever?" And then that really means that an agency is diving into their numbers and understanding where their costs are and what they're spending on. Because really, you can spend on anything, right? But you can't spend on everything. So you need to prioritize your resources, and that's what Carey's team helps you do.
And the other thing I would tell you is benchmarks are great. It's one thing to compare to, but the reality is if an agency's growing and they're profitable, there's a million different ways to allocate your resources, and it really should be personal. But it's nice to know how you compare to others so you can ask yourself and check yourself and say, am I really getting a return for what I'm trying to do in that area? Or would allocating my resources differently get me a different outcome? That's one of the things to consider, but I don't want anyone on this call to think that there's only one way to do this. So if you're above in your payroll benchmark, we're going to only move you to be at the benchmark. There's plenty of people that are far above in IT and advertising, but they're also growing at a faster rate than the average agency, and we'd never correct that. So again, it's meant to give you some introspective ways of looking at what your performance is, give you a gut check with what other people look like, but in the end, make an informed decision about your own business. So the P&L is something we pay very close attention to. I also use this as an example because it also is where we will calculate some of the other key KPIs that I think every agency should pay attention to by looking at your financials year over year or for several years in a row. You can start to see trends and where there are one-time expenses, things that you did that will not recur, so you can get to what your pro forma is if you're ever going to value your own business or another agency that you're looking to buy. It allows you to see it in a different way rather than just 1 year at a time. So super powerful as long as you can have context. And I think our team is really focused on giving you the context. I'll let you hit this one, Aaron.
Cool. Sounds good. One last thing on the profit and loss statement. If you hear it referred to as income statement, it's the same thing. So you might have like a bank tell you, "I need your income statement." It really is just your profit and loss statement. Why there's two names, no one knows. All right.
Yeah, I think it's just our way of making our world as complicated as insurance. And funny story, my daughter was doing we were doing some trivia questions, and she put the answer as multiple choice and listed profit and loss statement and income statement at the same time, or on two different things. And I laughed because the average person might think they're different things, but they're definitely the same. And we're just trying to confuse people. Apparently, who knew? Anyway, okay, let's do balance sheet.
Sounds good. So, as the income statement is for a time period, so it could be like January through December or 2024 or 2025. So it has a time period, a start and an end date. The balance sheet is just a snapshot on a particular day. So that's why you'll see a balance sheet say as of and call it December 31st, 2024, right? So it's a snapshot of all your assets, liabilities, and equity on that particular day that you're running the report for, right? So again, totally different than the income statement, which you could say, give me the last 3 years of data. The balance sheet, if you said, give me the last 3 years of data, if the end date, if the end date is December 31st, that's the date you're going to get. You can still run it year over year. So you could say like, give me December 31st of 22, 23, and 24, and compare those together. But you aren't able to run a time period like you would on the income statement. Anyway, so from there, this is going to list out again assets at the top. So bank account, bank balances, receivables. That'd be things like agency bill commissions for receivables in the insurance industry. Usually direct bill commissions aren't put in as receivables. We'll get into that into a basis topic a little bit later. You'll have other things like prepaid insurance, any security deposits, undeposited funds. Those are things that'll be assets on the balance sheets. Then you have things like fixed assets, so or intangible assets that could be like vehicles, or it could be like a website development or computers if they had to be capitalized onto the balance sheet. So that's the asset portion of the balance sheet. Pretty straightforward. Then you'll have your liabilities. These will be obvious things like premium payables or carrier payables for agency bill, credit card balances, if you have any loans, finance insurance, things like that that would be liabilities for independent agents will be on the liability section. And then the last part is equity. So you'll have several different kinds of equity. We don't need to dive into all of them now, but a lot of them will be around the stock that you initially put in if you're a corporation. For an LLC, it might be your membership interest. You'll have things like retained earnings, which is your prior year's profit and losses. And then distributions is a common equity account, which is money that the shareholders have taken out of a corporation or members of an LLC. So obvious balance sheet equation is assets equals liabilities plus equity. So in this case, you have your assets here balancing to your equity. So if you look at the total liabilities and equity, you'll see 344,000, and then you'll have 344,000 of your assets. So that's very important. If your balance sheet doesn't match, that means your financials are wrong somewhere, because simple debits and credits means they must match. But the balance sheet, I think, is something that is very underutilized. Carey can probably hop into more why. But the balance sheet, especially as you become a larger agency where you have liabilities from acquisitions, loans from acquisitions, that gets into your debt leverage, the amount you can borrow in the future or currently. It gets into a lot of different other ratios. But I think the balance sheet is definitely underutilized, not by Carey and her team because they will utilize it, but by agency owners in general. And that's because it's harder to read, right?
It
The income
is.
statement's
Yeah.
pretty straightforward. You got income and expenses, and you can read it pretty easy. When the balance sheet is harder. But Carey, what are some ratios you guys like to use on the balance sheet or use with your agencies?
Yeah, so your tangible net worth is something that you should be aware of, especially if you're going to do an internal transition. You want your tangible net worth to be over 22%. You want your liquidity ratios. You should be able to see that your current assets will cover your current liabilities 1.5 times over. So that is just saying what is the health of the agency and your ability to cover those liabilities or those loans or those commitments that you've made. So that's a very easy thing for you to see. I think Aaron's 100% right. There's a lot of people that never run their balance sheet. They don't run their balance sheet until they want to get a loan or they want to sell their agency, or there's a reason that someone has asked them to run their balance sheet. I was actually talking to someone on my team this morning who said, listen, I'm working on this agency's valuation, their balance sheet doesn't balance. And it's because it's not looked at, sadly. And it's unfortunate. But again, if your balance sheet doesn't balance and you're trying to do something and you send that to a potential buyer, you send that to a potential broker that's going to market your agency, they're going to think what else is wrong, because these statements are also linked together. So the equity section of your balance sheet is tied to your P&L. So if something's off, you got to know what that is. And you'd really need to have someone help you interpret what that is if you don't know how to read it yourself. The second thing I'll tell you, not just a ratio, but you have something called intangible assets on your balance sheet. And if you get a valuation done of your agency, those intangible assets typically include things like goodwill or an acquisition, a book of business purchase that you're now amortizing over time. Those things will be removed from your balance sheet in the process of valuing your asset, because we've already contemplated them in the profit and loss statement and the valuation of that. So knowing what those things are and that they're properly being amortized over time, or your fixed assets are being depreciated over time, really matters, because there's sometimes you see something on there, they're like, we purchased that book 20 years ago and it's still showing as an intangible asset. Well, it's long gone at that point, but they've never actually had an accountant take care of that and get it off of their balance sheet. So it's important, stay up on that and make sure that someone's paying attention, so you're not trying to fix that in a much longer period of time. Aaron, can you still see our slides?
Yeah, it looks good.
Okay, perfect. All right.
One thing too, the balance sheet is looked at so infrequently, even by accountants, that at our firm and most firms, we actually teach new accountants to read the balance sheet first, and when they're doing their month-end closing, to look at it first, because if the balance sheet is wrong, the income statement has to be wrong, just mathematically, right? And so when you're reviewing your financials, everyone wants to gravitate towards the profit and loss statement first. I would suggest looking at the balance sheet first, making sure that's accurate, and then making your way over to the profit and loss secondarily. Um, and yeah, I think that's good on balance sheet, unless you have anything else, Carey.
Nope, I'm good. All right. So can you see the next slide? For some reason, I'm looking right at you instead of the slides now, which is really fun.
Am I still on balance sheet?
Interesting. Okay, hold on one second. How about now?
Still there.
Crazy. Don't know why. Give me 1 second. Why? Sorry about that. This is really fun when you're the one running it, and I only have one screen, which is really funny. So gotta love when that happens. Okay. Let's see. Stop share and reshare. How about that? How about now? All right, here we go. Now I can do this. Perfect. Okay, so now we're on the cash flow statement. Sorry about that, Aaron.
No, you're good. Cool. Cash flow statement. So they also be called the statement of cash flows. They're both, again, the same thing, so don't let it be confusing. This is looked at less than the balance sheet. So if the profit and loss is the most common, balance sheet second most, the statement of cash flows, or the cash flow statement, is looked at the least. And it's because it definitely is the hardest of all of them to read. But really, the cash flow statement tracks the actual movement of your cash. And so if you can master reading this, you'll really know where your cash went. It's less relevant if you're doing cash basis accounting, which we'll get into in a little bit. But it is definitely more relevant if you have accrual basis accounting. So if you're a larger agency with accrual basis accounting, the cash flow statement becomes more important to find out where your actual cash went that month. Although still in cash basis, it's important to know where cash went. So you might, this is a common question I get, and I'm sure Carey gets all the time. Well, look, the profit and loss statement says I made $1 million, but I only have 200,000 in the bank. Where did the money go? And so that's a great question. And this statement shows exactly where it went. So if you look at the very top, it'll have your net income, right? And that is straight from your profit and loss statement. So really, this statement is saying, here is your net income. Why is cash different than the net income? And that's a good question. So the very top, you'll have net income, which is straight from your profit and loss statement. And at the very bottom, you're going to have cash at the end of the period, and that will match your balance sheet cash. right? So in this particular example, we're saying, oh, there was 1.8 million of net income. Where did all the cash go if there's only 262,000 of cash in the bank at the end of the period? And so again, question that comes up all the time. And now you would just read the statement here. So positive numbers means that cash is going up, and negative numbers mean that cash is going down. So in this case, you had accounts receivable increase, and it's kind of hard to see the negative, but you see how there's a negative right in front of the 70,000 of accounts receivable. That means that your accounts receivable increased, and therefore cash actually went down because as receivables increase, that means you didn't collect the cash, and so your receivables went up and therefore your cash in theory went down. And so you can follow that same logic all the way down through the operating or operations section there, which means anything that affects your operations, so accounts receivable, accounts payable, things like that, will fall under the operations category and show you why cash went up or down. Then you can look at your investing activities. In this case, this example didn't have any loans, but if you had loans, those payments would come off of the investing activities section. So for example, you might have a net income of 1.8 million, but you spent 300,000 on loan payments. Well, loan payments don't hit the profit and loss statement, right? That's not an expense, only the interest of it is the expense. So therefore, you spent 300,000 of cash on the principal of loans that didn't come off your income statement, and therefore it's a reduction of cash. And then the last thing, and this is the most common reason why there is low cash in an agency, is shareholder distributions. Those are not an expense to the agency, right? That's profit that the shareholders or agency principals took out of the agency, and it does not count as an expense. So in this case, if I saw this financial statement and the agency owner asked me, well, where'd all the cash go? I would say, well, 1.1 million went to you. So that is why your cash is lower because you took out that cash either in distributions or personal expenses that you ran through the business that we classified as distributions. So that, in a nutshell, is a statement of cash flows. Very important if you can read it. If not, Carey and her team can definitely walk you through it. But I think is one of the most important statements that is overlooked and really will help you find out where the cash went in your agency.
So this is a standard thing that we're implementing in every single CFO client at this point. So every CFO client gets a P&L statement, a balance sheet, a comparison to budget, a comparison to last year. So you can, and a parent comparison to benchmarks. So therefore you can say, how do I look compared to my plan? How do I look compared to how I worked last year? How do I look compared to other agencies my size? We've added this statement of cash flows because so many of our agencies are in acquisition mode, and it is a struggle. Like, I look like I'm doing great. I'm at 30% profitability. I have all this profit. Well, you've also committed to buy certain agencies, and based on your inflows and outflows, there could be months that your cash is actually a negative balance because of those other commitments that you've made, and we're able to then project out over the 12 months. This is when you're making cash, where your cash should go up. This is where your cash should go down based on the ebbs and flows of your P&L, so you can see and plan for it and actually plan your distributions to your shareholders accordingly, and not get yourself in a challenge where you decided you're going to take owner distributions equally over every single month, and not realizing that that actually creates a cash shortage at some point during your time frame. So it allows you to plan much better and understand that, and not rely just on the profit and loss statement and think that everything's great. So it's a common thing, but we're able to then help agents make better, again, informed decisions and understand what they're reading. I'm gonna let you take this for sure. The only thing I'll say about tax planning is, if you're buying an agency internal, you're buying an agency external, the structure of that deal requires tax consulting and understanding how to structure the deal. And whether you're a C Corp, an S Corp, an LLC, it matters. So having someone who, first of all, that your financial statements are right, and number two, that understands your tax position, is incredibly important in an M&A transaction or any other situation. So having someone who understands it is absolutely key.
Perfect. And to Carey's last point, if you have a consultant or a CFO that currently is not going through the P&L, balance sheet, cash flow statement, and benchmarking. Like, although that is extremely unique, that Carey's able to bring all that together because that's extremely difficult. You definitely want to make sure that all of that's being done, and obviously Carey and her team do that very well. So just heads up, if you're reviewing your financials, you're not looking at all of those items we just mentioned. That's you're missing out on some great information. Over to strategic tax planning, just tax planning in general. This is probably one of the most overlooked topics in accounting, right? So uh, again, there's competing forces, right? You might have a internal bookkeeper, or just a bookkeeper in general, or you might do it, or it's a bookkeeper down the street. They don't really have tax planning in mind necessarily. Then you might have a CPA who is just strictly focused on tax planning. And so then the financials that Carey gets make no sense because it's just all about tax planning, right? And so having this balance of financials, which you can use to run your business and also use for tax planning, is important. And when we get to tax planning, the reason why I put the 1120S in this slide is that uh, we run into a lot of agencies that aren't S corporations, and that's like low-hanging fruit of tax planning is you probably should be an S corporation or an LLC tax as an S corporation. That's not blanket advice for everyone, but I would say 90+% of agencies we run into should be an S corporation, and if they're not, we should talk about that. Um, when we get the financials completed for the year, we will prepare month or year-end adjustments for taxes, and then turn them into the tax team, right? And so again, if those financials are wrong, then your taxes are wrong. When we get to the tax planning portion, um, if you're signing up for a new service, or if you haven't spoke with your CPA or accountant all year long, you probably didn't really do any tax planning, and you're going to just write a check, or you're going to owe what you actually owe. Now, this isn't some Instagram ad where I'm like, do a cost segregation and you'll pay zero tax, and I'm like in a lab coat or whatever Instagram reels you've seen. And I've seen almost all of them because my clients send them to me all the time, and they're all really funny. I had one the other day where this guy, he sent me he's like, can I do this? And there was this Instagram guy who's like, I buy my vehicle and then I lease it to my company. And then it's basically like this inception of depreciation, and never had to pay tax, which was completely bogus. But we're going to give you real tax advice. And we know that they'll last through audits because we handle our own audits internally here with our tax attorneys. And we have a very low audit percentage. So we just take real practical tax advice, try to save you tax money. And the biggest areas are your entity structure. If you're buying or selling your business, structuring it correctly. If you're buying a book of business or selling your book of business, structuring that deal correctly. And actually, the most common, which we just ran into, is actually around how to compensate the agency principals. I could do a whole hour on that, but that's something we found to be the most detrimental to clients, is compensating themselves incorrectly. But it is essential to have tax planning, and something you should do, at least once a year or twice a year to make sure you're still on track.
Yeah. Okay, so this is something that I think you talked about it, and you said if you don't have producers, you may or may not want to do this. I have a different opinion on this. I think everybody could reconcile their commissions, and here's why. If you're ever going to sell your agency, let's say you don't pay commissions to your producers, but you're going to sell your agency, they want to know that I mean, you want to know and have the process in place that you can track and be able to reconcile your commissions and know what is new business, what is rewrite, and what is renewal. Because the average commission structure for a producer is new and renewal at different commission rates. And if you're not able to have the underlying process inside your agency to be able to do it, whoever buys your agency is going to have to implement that, and it could impact the way the compensation structure is going forward. So having solid processes, because you're in an industry that this is a common way to compensate, please, please, please adopt them if you want it to be transferable and you don't want there to be unexpected challenges upon a transfer. And the reality, I know we're talking a lot about buying and selling, but the reality is you should be running your agency like you're selling it, because anything can happen, and we're all not going to be the owners of our businesses at some point in our lives, because we all eventually will not be here. So you've got to adopt a way of running your business like you're selling it tomorrow, so you're ready when and if those things occur. So let's talk about, what does this commission reconciliation process look like? What does your team do, Aaron? And how can someone, what should they be thinking about with commission reconciliation?
Yeah, absolutely. So right now, commission reconciliation is still a bit manual because the AMSs haven't really developed a lot of automated processes with AI. However, there are a lot of up and coming software providers that are looking at automating this. They aren't quite there yet, but I think we are on the cusp of having some breakthroughs there. So, if commission reconciliation has been too expensive for you in the past, because it is a rather costly process, it probably will be available to you at a lower cost, I would say, sometime in the next year or two. Commission reconciliation process, this will be for direct bill mainly. You get commission statements in, you reconcile that into your AMS, and that opens
Sure.
up other reporting that you have. Um, and it also allows you to pay your producers based off of this. I will agree with Carey that if you don't have producer agreements or producers, or you're just paying them some random number, that is a lot harder to sell your agency. But the commission reconciliation process is pretty straightforward in the AMSs, and we're hoping that automation comes soon.
Yeah, not only that, like if you're paying your producers a base salary, and that means they're less likely to actually generate green new business, and it could impact your growth rate. It could impact your overall profitability. Like, those are the insights that we look at when we look at your overall structure. This is just some of the mechanics in order to get to the information that we need to make that analysis. This is something we talk about a fair amount. You want to hit on this pretty quickly, Aaron, about what's the difference between the two and what should an agency be?
Yeah, I'll hit pretty quickly on it. So you have cash, accrual, and gap basis. Most agencies will never hit a gap basis level. That'd only be if you have some type of covenant through a bank or investor that requires you to be a gap basis. So like if you get bought out by a consolidator or you sell to a consolidator, then your financials would likely need to be in a gap basis. But if you're going to operate as an independent agent, you very likely won't need to be in a gap basis. So we'll exclude that from the conversation. Cash and accrual basis doesn't have a huge difference for independent agents. It's really just based off of the timing of cash and accrual, right? And you're actually limited based off the AMS that you use, right? So if you're using Hawksoft or a similar software to Hawksoft, you're basically going to be in the cash basis no matter what you do. And that's totally fine to run your agency that way. And it produces accurate financials. So there's no need to panic like you need to be in the accrual basis. As you get larger and are maybe in a larger AMS like Epic or AMS 360, then I would suggest you do move to an accrual basis because that software will allow you to have accrual basis transactions. Cash basis really just means as cash comes into the business or cash leaves your business, that's when you pick up the income and expense, right? On an accrual basis, it's when was that income earned and when was that expense incurred? That's when we're going to classify that transaction then, right? Now, in independent agencies, there's really not a huge difference because there's one key factor is that direct bill commissions are typically always in the cash basis no matter what. So even if we try to do every creative accounting measure in the world, you really are always going to be in the cash basis for direct bill commissions, whether you're cash or accrual. And so if your primary source of income, like most independent agents are, is direct bill commissions, then no matter what basis you're in, you're really going to have the same revenue. Agency bill commissions can be cash or accrual. And then how you allocate the expense for commissions can be cash or accrual, but your income will be relatively the same. And that's really the key differences there. So my main advice is just don't panic if you're cash and don't panic if you're accrual. It's probably very close to the same numbers for you.
So I have one other thing to add to the cash and accrual conversation. So the other large occurrence inside some independent insurance agencies is contingencies. So you earn contingencies for 2024, and they are paid out to you in 2025 in the first quarter or maybe the first 4 months of the year. So if you were selling your agency, there are a lot of people who think, well, that contingency was attributable to the prior year. I want to have that contingency payment as part of the deal. Therefore, because it was attributable to there, but if you're a cash basis, it doesn't actually hit your P&L until 2025. So sometimes that's a term in one of the agreements about buying that agency. They want to know how we're going to handle that contingency payment. That's very unique to whatever deal we're talking about, but that is another thing that falls outside of that period of time. If you were getting audits, they would look at your contingency income year over year. And if there's a big swing, they might actually make an adjustment in order to make your year financials accurate because it is attributable to the prior year. So that's the only other thing that I would say, Aaron, that is, but again, I don't know the percentage, but it's pretty low of those that actually get audits every single year. That's fairly large agencies, and they might already be on that accrual basis. So those are the things to think about.
Absolutely. And one more thing is your tax basis and your books basis can be different. So we typically
I'm
always, for
sorry.
tax planning, want you to be in the cash basis for tax purposes, but that doesn't mean your financials can't be in the accrual basis,
That's right.
right? You can have separate. Go ahead.
That's right. Okay, so here's some things. Let's talk. We talked about the foundation and all these statements and the things that you need to be doing and how they interwork together and why it's important to have accurate financials. Here's some of the metrics that we believe every agency owner should know about their business. Number one, you should know what your growth rate is. And when I talk about growth rate, I'm talking about your organic growth rate. Year over year, how is the agency growing? Not from acquisition. You can know your overall growth rate as well, which is acquisition plus organic growth rate, but for your commission and fee income, how are you growing over time? Because it gives perspective, again, to how you're allocating your resources, and your performance plus your allocation gives you a much stronger picture of where you are. The second is your retention rate. So this is one where about 9 out of 10 agencies do not know their overall retention. They can give me carrier reports. It tells me their carrier retention, but they don't have a great way of really tracking their retention rate year over year for what is my revenue retention, my customer retention, and my policy retention. Especially in a hard market, you should know these numbers because your revenue can be very, very misleading because we have rate increases. So it can look like the agency is very, very strong from a revenue retention standpoint. But if you looked at your customer and policy retention, it's actually leaking. And when the market softens, you could actually be in jeopardy of not actually being able to maintain that performance. So this is something, when you look at the overall performance of the agency, if you know your growth rate and you know your retention rate and you know what the industry benchmarks are, you can decide, do I need to put a policy in place or put a process in place in order to improve my performance? Because every single metric you look at, you should have an action that you would take. So if my profitability is less than 25%, what action should I take in order to hit that goal? If my retention rate is low, what things should I do in order to be proactive and predictive on how my performance can be? So if you don't know what it is, you have absolutely no idea what that action should be. These are indicators that allow you to make a different choice inside your agency. I actually wear a hat for the last one, and I think we gave away something like 12 hats at the event that we're at today. It says EBITDA, which is earnings before interest, taxes, depreciation, and amortization. I apologize for the term, but it is literally your operating profit. And if you want to know the value of your agency, it is this number times a multiple to get to the value of your agency. This is the number that owners can control. So if you know what your operating profit is, you know one of the factors that will actually determine the value of your agency. And you know, are you above the benchmark, below the benchmark, and what can I do to actually change the performance and the overall value of my agency? Super important number to know. Many, many people do not know it. They know their premium, they know their revenue number, but they don't know their EBITDA. The last, or not the last, but then some of these are about efficiency. So you want to know, how much revenue per employee do I have? Yes, you include VAs in that calculation. We're talking about all the human capital that takes to run your business. There are benchmarks that can tell you, based on whether you're a personal lines heavy agency, commercial lines heavy agency, what should that be from a productivity standpoint? And if you're not in the range, why aren't you in the range? Some of the things that can impact that is the technology that you use, the overall structure of your agency. So if you're a tech forward agency where you're spending 3 times the benchmark in tech, your revenue per employee should be much higher than an agency that doesn't have that efficiency. So now we can start gauging your performance with your capacity to talk about the overall impact. Are you getting the return off of that technology? And if you're not, we should rethink it. Compensation per employee is another metric, and those two metrics together give you your spread, which is one of the most powerful indicators of the profitability of an agency. So if you have a strong spread, you should be more profitable than other agencies your size. And it's literally the difference between what is your revenue per employee and your largest controllable expense, which is your compensation per employee. And if you're able to cover that, a much more higher percentage than others, you will be more profitable. It's a predictor. Knowing that is super important. The current ratio is the balance sheet metric that we were talking about that tells you, are you able to cover your liabilities with your current assets covering your current liabilities? It's a liquidity and the strength of the overall, the financial strength of the agency. And then there's some other metrics that you should know, like if I have producers, what should they be producing? If I have personal lines producers, how much should they be generating in new business? What size book should they be covering? What size book should my service people be covering? So you can then start to think about, am I overloading my staff or are they underperforming? And the reality is your largest controllable expense is your people. If you don't get the compensation and capacity right, it's really tough to allocate resources to the rest of the agency and can put you in a position where you aren't able to see the same profitability as other agencies your size. So these are the reasons why, and hopefully some of the actions you would take if these numbers are out of whack. Anything you got there? So again, this is what my team looks at, and then it's not just about throwing numbers in front of you. It is, does it fit with the overall picture of what you're trying to do, and what action should we take in order to correct those things or adjust to make sure whatever your 3-year goal is and your 5-year goal is, we're helping you get to that benchmark. And these are some of the ways we can gauge the process. So I hope that we've given you a really good picture of what's the foundation, how do they work, and how do they position you to really think about the health of your agency and the power in the numbers that are on these statements rather than just making them look like gobbledygook. Because for a lot of them, that's what it looks like. A balance sheet doesn't mean a lot until you actually know what to look for. If a P&L doesn't really look like much until you have some grounding and basis to know what those numbers mean. And I think that putting some context to it can make it really, really important. It's a way that you can grow and expand your team. You can invest in the infrastructure and technology. You can evaluate your own value of your agency or the value in the acquisitions that you're looking at, and really think about creating as many opportunities for the future as possible for your agency. I don't know another, if you're going to make data driven decisions, I don't know another way to know the health of the business. But then by having sound financials and some of these other insights that come from having sound financials. There's no two ways around it, that one can't happen without the other. There's no possible way that I can't do what we do without Aaron's team and vice versa. One is not more important than the other, but they are both critical to the success of making strong financial decisions.
Absolutely.
Yeah. Well, I'm happy to answer any questions. If there's something that we talked about today that you have questions or you want to think about, or if you want to shoot those in the chat or unmute, we're happy to answer those.
Nice job on timing, Carey, too.
I don't know how we
Perfect timing.
managed that. Like, I just looked and like, wow, we crushed it. How about that? You think I do a podcast or something, right?
Yeah, do you do a podcast?
That's funny. Okay, I'm curious how one would find benchmarking. Is there an online resource? So there are there's some resources. They are not free. Benchmarking, there is a best practices report that you can purchase. I don't know the size of your agency, but best practices has benchmarks that publish agencies that are under 1.25 million in revenue. And then I think it's 1.25 to 2.5 million 2.5 to 5 million, 5 to 10, and then above 10 million in revenue. Actually, AgencyFocus has benchmarks as well. That's something that we use for our clients. Our benchmarks are broken down a little bit more because we know that 83% of independent agents are under 1.25 million in revenue. So lumping them all together makes absolutely no sense, in my opinion. So we actually have benchmarks as well. We provide those to our clients. And if you are interested, Lee, just reach out to us. Any other questions?
Yeah, Carey, I had a quick question about spread.
Yes.
So what is a healthy spread? And then when you're calculating it, is the spread, because you were saying income per employee versus employee salary. So the income per employee for a producer versus a customer service agent, right? Do you have multiple spreads for the different categories? Is that how that works?
No, so spread is overall for the agency, but you asked a really important question. The way that the owner compensates themselves can really skew that number significantly. So we're talking overall compensation per employee and overall revenue per employee is how you calculate your spread. And it's the difference between those two numbers. And there are benchmarks to say what's healthy based on the size of the agency. So I can't give you one number, but again, all of these benchmarks are based on the size, because you can imagine what that looks like in a $500,000 revenue agency and what it looks at a $5 million agency are very different. But there are benchmarks for compensation of each of those roles, but not like compensation per employee in each of those roles as well. But the spread is typically overall for the agency. Hopefully I answered your question. The other question that we got, Devin, hopefully I did, and if not, reach out. I'm happy to go deeper into that. But every single role has compensation metrics that are out there and benchmarks that are there. So super helpful. The one that's hardest is to answer is compensation for the owners. We had another question that was, what did you mean by having the general account, trust account separate in QuickBooks? And Aaron answered it. Do you want to verbalize that for the people that aren't looking in the chat, Aaron?
Yeah, absolutely. So when I mentioned that, it's a common mistake we run into where an agency will have their trust accounting in one QuickBooks file or one general ledger, and then their operating and rest of their expenses in another. So if you're doing that, you're not doing yourself a good service there. I would get all of that into one file. So your trust, operating, credit cards, loan accounts, all that should be one QuickBooks file.
Yeah, excellent. Fantastic. I love that we're getting questions, Aaron. That's like making me happy. People are geeking out with us, which is fantastic. If you have any other questions, please don't hesitate. If you want to reach either Aaron or myself, you can reach Aaron at, I don't know, you give them the thing, I'll tell them mine, but mine is www.agencyfocus.com. We'd love to talk to you about anything specific with your agency. And Aaron, do you want to give your contact info?
Yeah, you can go to myagencypoint.com, and that's how you can reach out to us.
Perfect. All right. Well, thank you for joining us today. I hope you got something out of it, and hopefully we demystified the financial statements a little bit and told you the power of the numbers that you have inside your agency. We will see you soon.
David Lane, I'll answer your last question on the company structure.
Oh,
S corp versus LLC. How much does the personal situation determine? An LLC isn't a tax structure. So the LLC can be taxed as a sole proprietor, partnership, S corp, C corp. And so very likely if you're an LLC, we would have you taxed as an S corporation. But feel free to reach out to me, David, and I can hop on and talk with you more about it.
So sorry I didn't see that question, Aaron.
It just came in right when you were talking, so you're good to go.
Okay, perfect. All right. Well, it was good seeing you. Aaron, thank you so much for joining me, and I will talk to you real soon, my friend.
Good to see you, Carey.
Bye.
Thanks, guys.